Hey, it's Rav, and welcome to the Everyday Investor, the hottest real estate investment show in the world. That's right, I said it. I don't care who knows it. I'm so excited today. Our guest co-host is expert real estate investor and teacher Simon Giannini, as well as we're going to learn from Mary Tan how she made 41% annualized investing in real estate. Let's get this show started. Simon, it's great to have you on the show.
Pleasure as always, buddy.
Thank you so much for being here. How's life? How's everything?
Life is good. Summer's here. Lots of activities, and you know what? Not the least of which is the real estate market just continues to defy all negativity and march forward.
And you know, we haven't been saying this for the last couple months, even the last couple of years. It's been a good, 15-year, 20-year run. I mean, there's a bit of a blip there in 2007 with the subprime mortgage crisis there, but that even only lasted, 3/4 of a year or so. Why do you think that real estate has been going strong for so long?
Well, look, the Canadian market is so different from the U.S. market. There was the old misconception that if it happened in the U.S., it's inevitable that it's going to happen here. But what most people don't know is the banking system is so dramatically different in Canada compared to the U.S. In the U.S., you could walk away from your mortgage. In Canada, you're stuck. And Canadians are conservative. They don't want to owe any money. And you know what? If they don't really know exactly what to do, they're just going to sit tight. And this is what happened. And we saw this in 2008 with the market crash. For about 6 months, Canadians didn't know what was going to happen. So the real estate volume slowed down a little bit. Prices actually dropped about 10%, and then 6 months later, they bumped right up 15% because all that pent-up demand was still there. All the investors were still waiting. In fact, a lot of the investors were buying when real estate went on sale 10% cheaper, and the returns just went up. So the basic economics pushed it forward, and we're going to talk a little bit more about it in detail during the show.
Let's talk about the indicators of why it's still a strong market. I always appreciate, Simon, you coming on the show because you're incredibly transparent. You're an expert. You write books. You've been on radio. You have a couple of your own shows here and there. But this wasn't easy for you. I mean, this is the Everyday Investor. This is what the show's called. We're just everyday people. I appreciate when you share on stage. I've seen you in front of hundreds of people share about some of the mistakes you made way back when. Kind of touch on that how education is so important. When you were, you look like you're still in your 20s, but when you were a young man, talk a little bit about how, just your experience through real estate.
Well, I'll tell you, when I started in the business, I was in my 20s. And, I got a real estate license, and at the same time, I wanted to invest in real estate. And the mistakes I made then cost me hundreds of thousands of dollars. I don't even want to talk about it. It makes me sick. But I'll tell you what I did see, though, the investments that were good through the storm and the investments that weren't. And we talk about cash flow a lot. So, some of the investments were purely speculation. I bought a couple of condos. I was hoping that, I bought them for $1. I hope they go to $2. And when they dropped to 75 cents, I lost all my money. At the same time, I had cash flow investments. I had, what we call bungalows, ranch, single-family homes, single-level, basement apartments. And when the market softened in 1989 and 1990, you're too young to remember that, of course. But when the market softened, what I discovered was, my mortgage didn't change because I had a 5-year mortgage rate. Rents actually went up. So during this massive storm where everybody was panicking, because my cash flow was there, I didn't need to sell. I hung in, and then of course, we're talking homes that we bought back then for $100,000, and of course the rest is history.
So what I hear you saying is, we got to make sure we're not buying property, investing in real estate just for the appreciation. That's speculation. You want to make sure that there's the other components, which again we'll talk about, especially when Mary comes, on the show and we look at one of her investments. We want to look at somebody else paying down our mortgage. We want to make sure there's cash flow there. That's kind of really the meat of the deal. And then the appreciation, as you've always taught, it's gravy. And it just so happens that it's good gravy. It tastes real good right now in the GTA.
Absolutely. And here's the thing. Long term, there are ups and downs in real estate. To say otherwise is naive. So if we really think for the long term, I always say let's invest and get rich slowly. and do it safely. And I think that resonates with people because the biggest fear is risk. The biggest fear is losing money. And Warren Buffett said, rule number 1 is don't lose your money. And rule number 2 is don't lose your money.
Yes.
So if we can invest making sure, hey, we're in it for the long run, and no matter what, we're not going to lose the money we put in, we're going to do well.
Yeah, no, absolutely. I mean, I've heard it said it's not about timing the market; it's about time in the market.
Yeah.
And you've taught, Simon, that this is you're doing it right when it's slow and boring. You know
Absolutely.
What I mean?
I want my investments boring and consistent, and I want my life exciting, not the other way around.
Yes.
And I've seen a lot of people get a lot of stress and lose a lot of money doing it the wrong way, because it's easy to get caught up in the hype, especially with the condominium development market in Ontario and in Toronto. Obviously one of the biggest in the world, the biggest in North America by far.
Yeah.
And it's people look at that and they're concerned. Are they building too many condos? Is the market going hyperinflated relative to what the market needs? And once you understand the market indicators, once you understand the real numbers, you'll see that it's very logical, it's very predictable. In fact, the experts are predicting a condo shortage in many of the strong markets within 3 to 4 years.
Is that right?
Yeah.
Yeah, no, absolutely. I mean, I look forward to getting down in the nitty gritty to look at the indicators. Again, you've written books. The last book is called?
Everything you want to know about real estate, and we update it annually, because to deal with what are the current market stats, what are the hot areas to invest in, how do you find property, how do you negotiate the deal, and all of that.
Okay, great.
Yeah.
We're talking to my good friend Simon Giannini. We're learning how to invest in real estate. You don't want to go anywhere. The Everyday Investor continues in a moment. Thanks for watching. Whenever you're considering to invest in real estate, always ask the 4 questions to start. Number 1, what is the return on investment? Number 2, when do I get that return along with the money I put in? Number 3, what is the minimum cash amount needed? And number 4, what is the risk in the worst case scenario? Hey, it's Rav. Welcome back to the Everyday Investor. We're here with my good friend Simon Giannini, real estate investing expert. We're talking to him about how to make money in today's market in the GTA. But right now, we're going to go to our mortgage guru extraordinaire. Carmen Caponero is on the line. Hello, Carmen.
Hi, Rav. How are you today?
Good. How are you?
Good. Very good.
Good.
Nice and warm out for a change.
It is. Carmen, it's always great to get your expert advice. The question that I've been getting as of late is, Rav, what happens if rates go up? A lot of people, I wouldn't say a lot of them are concerned or worried, but there is a handful that are worried about it. What would you say to the person that asked such a question? What happens if rates go up? Number 1, will they go up astronomically if they do go up? And what would you say to that?
Well, I would say that for people that are on the more conservative or concerned about rates going up, you can take 3, 5-year, 10-year terms to lock into. And even if you have a variable rate, which has been historically for the past 15 years the lowest rate between a fixed and a variable rate,
Yep.
I would take that because then you can lock in at that point. Anytime you see rates starting to go up, you can lock it in at a fixed term. And then you have the comfort of knowing that you're not going to be looking at significantly higher interest rates.
Okay.
I've heard through the grapevine, through the industry and the economists from the institutional lenders that we deal with, that they are saying that we're in for another 3 years of low rates. That's what they've been telling us. So that's great news.
That's great news.
Keep buying real estate.
Thank you, Carmen, so much for your advice. And I think you are on the show in a few weeks. I can't wait till you're back.
I know. Look forward to it.
Yes.
Thank you very much.
Okay,
Take
Carmen.
care.
Thank
Bye-bye.
you. Thank you. It's interesting, Simon. I mean, everyone talks about that, right? The mortgage rates and do I lock in and I got a variable and I got a fix. And, you could be sitting around, playing some cards and one guy is at 4%, another person's at 3%. And they think, what's the big deal? It's only a point. Well, 1%, on a $400,000 mortgage over 5 years. I mean, correct me if I'm wrong. That's $4,000.
Yeah.
1% on $400,000. $4,000 times 5. That's a $20,000 difference.
Yeah.
So we don't need to worry and nickel dime everything, but we do need to have knowledge in this area of borrowing money.
Absolutely. I mean, the way I look at it is, if I was going to analyze an income property, I would do my forecast based on the fixed rate. I might even add a little bit. So if fixed rates are 2.5, I'm going to forecast it based on 3. then I'm going to take the variable rate, and that's what I'm going to actually pay.
Yeah.
So that spread of 75 beeps is a bonus in the short term, and it's my cushion long term. But I laugh because first place I ever bought had a 12% mortgage. So when I see people concerned about 2.5 going to 3 or 3.5, it's money is free. Inflation is at 3%. We're getting money at cheaper than inflation.
Yeah, yeah, and I think the key though is to not over leverage. I mean, give you're a dad, give your parental kind of views on that. Are you concerned that there's people out there? There's a lot of people out there that are over leveraging. That we qualify for 700,000, so therefore we should buy 700,000. What are your thoughts?
Well, I'm not seeing that with investors. We've always seen it with first-time buyers. First-time buyers qualify for 500, and they insist on trying to get 550 because they want to keep up with their cousin and their brother and their neighbor, and that whole thing. Yeah. But at the end of the day, the bank won't give them financing for more than they qualify for anyway. So this whole concern about the Canadian debt levels, there's good debt. You know this. There's good debt and there's bad debt. Bad debt is, all the disposables, all the things, depreciating assets, cars, boats, TVs, all of that. Yeah. And your home as well is also considered bad debt if it pushes you to the edge from a cash flow standpoint. Now, from an investor standpoint, we're looking at cash flow, and you have to go typically minimum 20 to 30% depending on the investment type. So we're looking at a lot of leverage, a lot of equity there at the same time. And at the end of the day, even the banks are looking at what's your cash flow. So there's a built-in safety margin. There's a built-in safety net that most people are not aware of. Yeah. You literally cannot get into trouble if you do it correctly. If you do it correctly.
Yeah, and I think there's a lot of us investors, and me in my my arrogance, if you will, hope not so much now, that would the banks are so stingy and they won't give me money, and I want the whatever, the 10th property. And listen, we live in a great country. We live in a great area. And I'm glad that the banks are quote unquote stingy because everybody wins this way, right? For an investment property, you're right. We should put down 20%, 25% to make sure that we're not over leveraging. And if anything were to happen, we have that room.
It's that safety margin. You know, just like when we saw the market correct by 10% for 6 months in 2008, 2009, anybody has 20% equity. Well, why worry about it? A great man once said, I won't use his name again, but a great man once said, you can always tell who's swimming naked when the tide goes out. Yes. So, swimming naked means having no equity, being highly leveraged, cash flow at the edge. That's when you get into trouble. Yes. So we always advocate investing conservatively for the long run and making sure that even the worst case scenario is no big deal. Yeah,
and it's unfortunate because the headlines always talk about the person who didn't invest conservatively, and then everybody's turned off of real estate investing where,
it's not responsible.
The returns can be amazing. As, Mary comes on in the next segment, we learn how she made over 40% in 1 year, but these are typical returns for everyday people. Yeah. We've brought a few graphs here. The first one's very interesting. I mean, we talk about they just met to talk about the Greenbelt, and they actually didn't expand the Greenbelt. They've actually kind of, they didn't allow developers to build more. They've actually expanded the Greenbelt. You can build less and less. And so talk a little bit about this shot here, Simon. The green, obviously, is where we cannot build.
Correct. So Ontario created something called the Places to Grow Act, 2005. Yeah. And the green area, as you can see on the map, is where we cannot build. So when I look at that, what I see is what's caused the Manhattan effect.
The Manhattan effect.
And the Manhattan effect is really simple. If you go to Manhattan, nobody expects that they can afford a house. Yeah. Because it's a little island, and if you look at the Greenbelt, we can't build to the north, we can't build to the east or west, we can't build in the lake. You can buy a boat, but that's about it.
So we're on an island.
So we have limited land, and there's very few subdivisions left. In the city, there's very few sites for high-rises left. We're running out of land, and because of that, it's basic supply and demand. We have massive demand with an ever-increasing population. We'll talk about that. Yeah. And at the same time, the supply is fixed, and it's very simple. 5 hot dogs and 10 people that want them. Right?
And Mom had always told me now we have a business.
That's right.
Right? When you have more demand than supply. And so, let's talk about, what is creating this. I mean, just fundamentals is there's a lot of people moving into the GTA. I mean, what are the stats on that, Simon?
Stats Canada predicts that by the year 2035, the GTA will grow by 3 million people. Yeah. And what we're seeing is, imagine the entire cities of Vancouver, Calgary, Edmonton, and Nova Scotia, all all coming in to the GTA.
Yeah.
On an annual basis, what that means is we're getting about 100 to 150,000 people, which means 40 to 50,000 new households every single year. And I want you to understand that. We sold 100,000 homes in the Toronto Real Estate Board market last year, 2015, and it was a record year. But now January 1st, we have another 40,000 families showing up at Pearson, some from Canada, some from all over the world, and they're the right demographic. That's the other key that people don't realize. It's the family unit age. You know, people between, I would say, between 30 and 50. So there's a lot of people, they're working, they're adding to the economy, and they're adding to the GDP. The housing market is such a massive driving force to the GDP across the country, both in the resale market.
What does that mean, GDP?
Well, gross debt. I mean, gross income. So the
economy, basically.
The economy in general.
The economy is growing.
I buy a house. Well, Mary's going to buy a house soon. She's going to close on her house. Well, she's going to pay the real estate guy. She's going to pay the lawyer, the movers, the contractors. All that money's going to go back into the economy. And all that money's going to go, they're going to be spending it again. So there's that multiplier effect. So, you know, the feds want to stimulate any sector of the economy that's bringing money back into the economy. When you look at the pre-construction industry, the development industry, they employ hundreds of thousands of people across the country, and it's a huge driving force, both for not just for municipalities, but the provinces and the feds as well. It's increasing taxes, it's increasing income, it's increasing employment. If the economy gets busier and busier, it's good for everybody, and that's what's happening.
You know, one of the things that people don't know, and you could just Google it, we have consistently been, you know, 3 cities in Canada have consistently been year after year after year the most livable cities in the world. I mean, meaning that's where people want to live. Vancouver, Calgary, Toronto, and frankly, even in the top 5. The other cities are, you know, a few in Australia, New Zealand, Europe. It's funny, the thing that they have all in common is the social justice. You know, they tax the people, but they put it into the city. And so no wonder so many people want to move in to Canada, to Ontario, to Toronto.
It's a stable environment. It's a safe environment. And you know, my family came from Beirut just before the Civil War. I know lots of other people that came from places that were less than safe. And we come here, and yes, it's cold, but the economy is amazing. That we have the most culturally diverse population in the world in the GTA. You look around, and it's people from all over the world, and of course they have more babies, and more friends and family are coming over. Population growing. It's a self-perpetuating process. But it's from an economic standpoint, it's really simple. We have a strong economy. We have a limited supply of real estate, and we have more and more people that want to live here. And why wouldn't you want to live in Vancouver? Why wouldn't you want to live in Toronto? This is an amazing city to live in. There's so much going on, culture and everything else.
So when it comes to real estate, like when it comes to the actual tangible real estate, what are some of the indicators that make it so strong right now? What are some of the things that are, you know, creating this? And I don't want to say boom. It just is what it is.
Well, you know, when a patient goes to a doctor, they take their temperature. What's your blood pressure? You know, how's your blood sugar? Are you breathing? How's your heart? And all of these different things. Well, we can take the real estate market's temperature at any given time. We can literally predict a market crash or a market correction. We really, really can if we watch these indicators. One of the most important ones is vacancy rate.
Vacancy rate.
Vacancy rate. What does that mean? Well, right now in the GTA, on average, it's 2 to 3% vacancy.
Which is extremely low.
Extremely low. If you go back to 1989, 1990, when we had the market crash, probably one of the worst conditions I can think of in the last 50 years, we had a 12% vacancy rate. We had 12% mortgage rates. So that's the second one. We have low interest. So we can buy more real estate with less money.
So we have low vacancy rates. I mean, all the, you know, the investors who have their condo units or homes or whatever, they're being filled.
We can easily rent them out.
Secondly, we have extremely low interest rates. So affordability for the investor is there.
Absolutely. So as an investor, yes, I have to put my 20% down, but I can get financing at lower cost than ever before in history. I can rent out my units easily, and notwithstanding rent controls, you know, market rents are actually keeping pace with value increases. So, you know, if you have an existing tenant year after year after year, you're a little constrained. But once a tenant moves out, you know, we'll talk about that in Mary Ten's case study. Once a tenant moves out, you can clean it up a little bit, and then you can now get market rents again. So it's keeping up your income, just like any other business. You know, what's wrong with a business that you can borrow money cheaply, and you can get higher and higher incomes on lower costs every single year. Costs are going down, income is going up. Great business.
Great business.
And that's what it is.
And nothing's lasting. I mean, days on the market, there's not like, the old 90, 120, 6 months. I mean, things are getting snapped up. There's
80 to 90% of homes are selling in 7 days.
Wow.
It's a process.
Yeah.
And people don't understand it. It's actually a fairly efficient process, because really what it is an auction. Values are 500.
Yeah.
Sellers are listing them for 450, and then the home is selling for 501. But the media is reporting that it sold for 51,000 over asking.
Yeah.
Well, asking price is irrelevant.
Yes.
What's the true value?
Yeah.
What's the true value?
Yeah.
And that's what makes sense.
Absolutely. I could put it for $1 and it, sells
That's
for
right.
800,000, but that's really the market value.
That's right.
We're talking about good friend Simon Giannini, real estate investing expert. You don't want to go anywhere. Mary 10 is going to teach us how she made 41% on her first investment property. Thanks for watching. Did you know that condos have become the new starter home? They account for more than 50% of all resales in the GTA. Hey, it's Rav. Welcome back to The Everyday Investor. We're learning how to make money in real estate investment properties. Simon Giannini, real estate investing expert, is my co-host for today. And I'm also joined by Mary 10. Mary, it's great to have you on the show.
Great to be here, Rav.
Yes, thank you for coming here. And you're doing very well investing in real estate.
We're not doing bad.
Yes.
I mean, it's not really about doing well, you just have to get into it.
Yeah.
So.
I mean, it's interesting that you say that, because once you jump in,
yes.
I think before the break I said it was your first property. I was mistaken. This is not your first investment property that we're going to look at.
This is our third.
This is your third property,
yes.
Because once you kind of you get involved, I mean, sky's the limit. And again, Simon, slow and boring.
Absolutely, just one by one. And I've described real estate income properties as an ATM that you can just tap into forever.
Yeah, but you got to know what you're doing.
That's right.
Absolutely. Absolutely.
And so tell me the impetus of why you got into real estate investing.
Well, we initially got in for our kids. We knew that with the increasing property values, excuse me, they were never going to be able to afford a house. I have a 14 and a 12-year-old, and then also a 3.5-year-old.
Oh, congratulations!
Yeah, I mean, we always kind of add her on in the end, because she was.
A gift.
She kind of it kind of evolved.
Yes.
We did it for them initially. We wanted to give them something later on when they reached adulthood, so that's how we started, and that's why we started. And from there, we just can't stop. I mean, we sold 2 properties, and with nothing to buy for a while, because it was so scarce, and we were looking for a property and we couldn't find anything.
Yeah.
And it just felt like money was molding. I mean, it wasn't. We just had to get something.
Wasting away, yeah.
Yeah,
Yes.
you had to get into it.
You want to get a return on the investment, right?
Absolutely.
I mean, that's the first question we always ask is, what's the return on investment? On this particular property that we're going to look at, you made over 20%, on the first year, and now you're going to do some things to it, and the returns will be well over 40%. Simon, this is one of the things that you teach. When you take something and you change the use of it, or you add to it, that's really when we make money in real estate. I guess we talk about, that would be called underperforming property, if you will. Touch on that.
That's one way to look at it. I mean, look, we're always looking at, there's a real estate concept called highest and best use.
Highest and best use.
Highest and best use. So what's the highest and best use of a property? So how do we maximize returns, for example? In Mary's case, you'll hear how she did it.
Okay.
But we can either improve the physical space, or we can add additional space. We have a lot of cases where we add a basement apartment, or we convert a single into a duplex. How do we get the highest and best use out of that piece of real estate? How do we buy it at the right price or better?
Yeah.
And how do we get the highest ROI possible on that investment with the minimum risk?
With the minimum risk. And I mean, and another, it would be like if somebody had an acre of land downtown Toronto, they were using it as a parking lot.
Right.
You can make some great money using that as a parking lot. You could probably make a lot more money if we turn that into a low-rise, high-rise, whatever the case may be.
Yep.
In Mary's case, you bought I'm guessing, a single family unit?
It was. It was actually 2 units, but they were not legal suites.
Okay.
So they were rented out as 2 units, an upper and a lower.
Okay, and then what are you going to do to that?
We are going to renovate it.
Yeah.
It was actually pretty good when we bought it. The kitchen was done, the bathrooms were done, the expensive stuff were done.
Okay.
We just needed some paint job. The flooring needed to be changed out. We're going to retrofit it so that it is a legal 2-suite unit as well.
Retrofitting means make it legal.
Yes, to make it legal.
Okay.
Yeah, and we had the retrofit specialist come out, and it really wasn't that long of a list of upgrades.
Things to do. Okay, great. Well, let's get out of here. So, before we even get into our project, you purchasing this property, your return on investment was what?
24%.
24%. So your ROI on this property, I mean,
As is.
yeah, as is. Simon, that's ridiculous. I mean, she's going to double her money just as is, in 4 years, right?
And if we can start there.
Yeah.
When I talk to newbie investors and we tell them you can get returns of 24%, a lot of them are skeptical because they've been so brainwashed to think that 6, 7, 8% is the most you can expect. Brainwashed by those other asset classes that we won't talk about. But it's the power of leverage, and it's all the ways that we make money when we invest in real estate the right way that gives us this cumulative return. But of course, Mary is an experienced investor. 24 is not good enough, so we looked at how do we increase that, and we'll talk about that.
Okay, so 24% is what we're doing here. So teach us, Mary, how you did that. So your purchase price on the property was what?
$510,000.
$510,000. So that's your purchase.
Right.
And where is this particular property located?
In Pickering.
In Pickering. Okay, so $510,000. That's the purchase price, and so obviously there's a down payment here.
Of 20%.
20% down payment which would be
$102,000.
Okay, so $102K is what you're in for.
Right.
And what else do we include there?
Closing costs
Plus
were
closing
about
costs?
$10,000.
10K in closing costs. Okay. And anything else?
At the time, no.
At the time, no. Okay.
Right.
So we are in this property for $112,000. Correct?
$112,000, yes.
Yeah. So we're in the property. This is what you are in. And we say out of pocket, but we're not even going to get into equity out of our home, credit lines, all that kind of stuff that really makes...
That's another show.
Yeah, that's another show, because then it's an infinite return. It's not infinite return. It's not 24%. But let's just say that this is out of pocket, as is. Mm-hmm. So we always teach, and please correct me if I'm wrong, we teach that we make money 3 ways. Well, more than 3 ways, but just to start, by it just going up naturally, by a little bit of cash flow if there is, and then, somebody paying down our mortgage. Right? So it just goes up. Simon, is that correct? Mm-hmm. Just correct. Passive inflation, it just naturally goes up. And I always hate talking about it in the GTA because that natural appreciation's been 10, 15%. Mm-hmm. But conservatively over 50 years, maybe, it's 3, 4, 5%, that kind of thing.
Well, actually, the real statistic over the last 40 years is above 7%.
Is it above 7%?
Including the ups and downs.
Wow.
Yeah, including the market corrections.
Say it again.
7%
over
average over the last 40
years.
years, including the ups and downs.
Wow.
If you look at the entire country, it's been about 6%.
Wow.
So, if you want to be conservative, we hope for the best, but plan for the worst.
Yeah.
We use 6 or 7% in our forecast, knowing full well we're going to get 8, 9, 10, 12, and those are just bonuses. We don't count on those, but we know they're going to come.
I must be a real scaredy cat because I've been using 3% all the time.
Well, we double it at least, yeah.
So this goes up on our 510 naturally. What did we give ourselves for the inflation?
I said 4.
4%.
4% was about $20,000.
$20,000?
$20,400.
Okay, so we made $20,000, $400 there.
Right.
And then is there any cash flow here? So cash flow. Yeah.
So this one actually had a negative cash flow.
A negative cash flow because your whole purpose of purchasing this was to make it a project, to get it up to speed.
Right.
We're going to look at what that's going to look like after. So this actually had a negative cash flow, so we're minus here.
Right, of $20,040 or $2,040.
$2,040
annually.
Okay, so this is a negative.
Right.
Okay, and then And then they're paying down your mortgage.
Yes.
And how much are they paying down our mortgage?
That worked out to be $88.50.
$88.50 a year.
Yes.
Right? They're paying down our mortgage, the principal. So
Well, that's year one, but it'll actually increase every year after that.
yeah,
Right.
yeah. So yes, of course, we make more and more money. This is going under the mattress. This is the principal. The rest is interest. But over time, we pay the most interest in the beginning, Simon. That's what you're saying?
That's right.
Okay. So I don't. Do we have these numbers worked out here? If we take these
26,410.
26,410. So you took 2,400 minus the 2,000, and then added the 88.50.
Yeah.
Okay, because they're watching at home, Simon. They're going to call you.
My math is good.
Everybody call
math
Simon.
is good.
Okay, say it again.
$26,410.
$26,410. So this is what you made in the first year. So whenever we want to figure out our ROI, we take our, let's call this
Our total return.
total return profits, divide it by what we're in for, and that spits out
24%.
26,410 divided by 112K, and that equals the 24%. Is that what we're saying? Just by doing really
Nothing.
I mean nothing.
Walking
You've
in.
done nothing. There's no renovation cost here.
Nothing.
Whatsoever.
Not yet. Right.
And you are not satisfied with doubling your money every 4 years.
Well,
We can do better.
that and the negative cash flow. So yes, absolutely, we can absolutely do better and easily.
Yeah.
Yes.
Yeah. Yeah, no, I mean, the negative cash flow, it's not something that we want, but in this case, Simon, you're okay with it because we're not going to stay there. We're going to do something else to the property.
Correct. We're going to correct it.
We're going to correct it.
Yeah, this is a business that needs a Band-Aid.
Yeah.
And needs some, fertilizer and water.
Yeah.
So we're going to, clean this up.
Okay, so we've got a couple minutes before we go to break here. Clean it up for me. So what are we going to do? What are the expected things that we can do here?
We're planning on putting in $15,000. So like I said, it wasn't much of an upgrade.
Yeah.
The kitchen and all that were already done. There were already 2 separate units, just
Yeah.
not legal.
Yeah.
The electrical was fine. I mean, there were, the meaty, expensive stuff were already done.
Okay.
So
if we're going to put in $15,000,
Yeah.
then I'm in now for 127. Correct?
yes,
I'm in for 127, but this up is good. The up is I guess that will stay the same, Simon, right? The up will still stay the same. The inflation.
Well, no, because the passive appreciation, I don't know what figures you use, but we've renovated a property. We've increased the income.
Got it.
The valuation
So
is
the
going to be
natural
higher.
up may stay the same, but now we have forced appreciation.
Yes, so we're adding the fourth way.
Yes. So for her, she's adding to this 20,400. If I put in 15 grand, how much now can I increase that property value?
So what do we Mary, what do we calculate for cash flow now once it's renovated?
so the cash flow would
Yeah.
be 33,000. It was 3360.
3360 is our cash flow.
Positive.
Yes. Positive.
Positive cash flow. 3360. So we're adding this because you were actually negative before, so we're adding the 3360 for cash flow.
Right.
Correct? But we're still adding 15,000 to this reno.
Right.
So I know from experience says if I'm adding 15,000, then I'm really making an extra 10,000, 15,
Well, yeah, I was being conservative, and
Yeah.
I said 20,000.
20,000.
So we increased it, the value by 20,000
Yeah.
by doing a 15,000 reno.
Yeah. But we take away the 15 that we put in, so we actually made $5,000 there. Correct?
Yes.
Yeah. So we made, by forcing it, we made 5K there. Okay, so this is a new number.
I'd actually put 20K there because we've accounted for the 15 on the other side.
We accounted it on the other side.
So
correct.
we put 20K
So
there.
we put 20K there plus the 33.
Yeah.
Right.
Right? So we've already increased almost about $25,000 because we were minus. We've already increased another $25,000.
Right.
So when we take this here and we increase another $25,000 below, now we're kind of taking $50,000, dividing it what we're in for, and that's what brings us over the over 40%.
That's correct.
Because now
Right.
your total return is over $50,000
That's right.
on a $127,000 investment.
So that's what we're doing here. We're forcing it. We're increasing the property, and that's how we're getting the over 40%. Mary, thank you so much for being on the show. Good luck. You have to come back when you get your 4th or 5th property.
Absolutely, I will. Looking forward to it.
Wonderful.
Thank you.
You're watching The Everyday Investor. You don't want to go anywhere. We'll come right back with Simon Giannini's thoughts on how we can make money other ways in the real estate market. Thanks for watching. Did you know that Toronto real estate prices are still a bargain compared to most major cities in the world and offer a higher return on investment? Hey, it's Rav. Welcome back to The Everyday Investor. We're talking to my good friend Simon Giannini, real estate investing expert and teacher. Simon, it was great to have Mary there just for a few minutes and to, just see what she's done, and a lot of people, and it's not wrong, they would stop right there, buy the property, tenant it out, enjoy the natural inflation of the property, enjoy the what we call the debt reduction or the principal pay down of a tenant paying off our mortgage for us, and some cash flow. And actually in hers, there wasn't even positive cash flow, and she was making 24% annualized. Yeah. Just right there, we were talking before the break, the little anecdote you had by, Bob and Doug. Yeah. Talk about that for a second.
Well, I love to tell the story of Bob and Doug, and I think, they're near and dear to our hearts as Canadians. But I use Bob and Doug as an example. And let's say, Bob rents for the next 25 years, and his brother Doug buys for the next 25 years. He buys a property and sits on it. Now, this has never happened in Canadian history, but let's say the value does not increase $1 in 25 years.
He bought it for $100,000. Yep. 25 years later, it's worth $100,000.
That's right. Yeah. And, Bob and Doug are having a beer, and Bob's laughing at Doug, and he said, you made a terrible investment. You didn't make any money at all. He said, well, hang on a second. It's 25 years later. I have no mortgage, and I own a piece of property that is worth $100,000, and I have no mortgage on it, so I've made $100,000. So my initial investment of, let's say, $5,000 deposit, 5% as a first-time buyer, has now increased 20-fold in 25 years. So simple interest, I probably made about 80% return on my investment. At the same time, my little brother, your rent has gone up every year for the last 25 years. How much money have you spent, and how much money did you get back? Yeah. But don't worry, I know you're broke. You can always live in my house because I have no mortgage.
I love it. But it's true. I mean, again, people look at buying properties and it's speculative. And speculative just simply means, Simon, that we think that it's going to be worth something, and it may or may not. Now, we have history that tells us that real estate goes up and down upwards. Yeah. It will always increase over time. But the real meat is I'm putting down, as an investor, 20%. And somebody else, or 2 or 3, if it's a duplex or a triplex, is paying off the other 80%.
Well, we're using other people's money.
Yes.
We're using the tenant's money to pay off the mortgage, which is money that we borrow from the banks. We use the bank's money to buy the property. We use the tenant's money, and we're putting in a little bit of our own money, and we're putting in our own sweat equity. But simple example, if you put 20% down, and the market goes up by 5%, and we know historically it always goes up higher than that, but let's be conservative. So the market's gone up by 5%. You've just made, just on that one aspect of it, 25% return on your money. And if you haven't sold the property yet, there's no tax incurred on capital gains.
I think you have to say that again. So, because this is important what you're saying. This is on any purchase price. On any purchase price, whether you buy a property for $400,000, $500,000, $1 million, $100,000. Let's just use $100,000 to make numbers easy. Yeah. You put 20% down. So on the $100,000, I'm putting in 20 grand. I'm in for 20 grand.
That's right.
And if it goes up 5%, which is less than the 40-year average you've shared, then I take that $5,000. I divide it by the $20,000 that I'm in for, and that will spit me out 25% return on investment every time.
Just on the passive appreciation.
Just on the increase. Just on we didn't even talk about the meat of somebody paying down my mortgage over 25 years, of the cash flow, because we always want to make sure, in most cases, and even in Mary's case, because she's going to do something different to the property, we want to make sure that there's more income than there is expenses, which equals cash flow. I mean, that's very interesting. I mean, we don't think about it that way.
That's right. And there's another thing happening as well right now. Because rates are so low, there's a much bigger percentage of mortgage payments that are going towards principal than there would be if the interest rates were 5, 6, 7%. It's almost 50% in some cases, depending on the amortization. So if you have a mortgage payment, mortgage payments on the average property in the GTA of, let's say, $2,000 a month, that's $24,000. On average, I would say, just round numbers, you're making $10,000 in mortgage paydown, which is real value.
Yeah.
The value is going up, mortgage is going down. This is all equity. This is all your wealth.
If the mortgage payment on my investment property is $2,000 a month, $24,000 a year,
yes,
you're saying that almost half, $12,000 of that goes right under my mattress. It
That's
goes right into my pocket.
And it's tax-free.
And it's tax-free.
Because it's mortgage reduction. It's not cash flow, and it's not a passive appreciation. It's not a capital gain. It's free money because you're paying down the debt.
Even if it's an investment property, somebody else is paying it down.
That's right.
That's tax-free.
All of the, if you pay you wouldn't want to do this.
Yes.
But if you paid off your entire mortgage, if you had a $400,000 mortgage on a $500,000 house, and over 10 years you paid it down, that $400,000 of wealth that you created is tax-free.
It's tax-free.
Because it's not a gain and it's not an income.
Yeah.
But you don't want to pay off your mortgage. Now, we could do an entire show on that.
Yeah.
But that's the other mistake that we see.
Let's talk about that in a second. We don't want to pay, but I want to be back up. If somebody pays off my entire mortgage, it's tax-free. I'm only taxed on, and correct me if I'm wrong, I'm only taxed on half of what it's increased. So if that $500,000 property is now $600,000, we've made $100,000.
That's right.
I'm taxed on $50,000.
If you sell the property.
If I sell the property.
Yeah.
Okay.
Well, what we now know, as most successful investors know as well, we don't sell the property.
Yeah.
What we do is we'll always manage the debt to make sure we minimize tax. And here's a simple example.
And is this all in your book, by the way?
It is all in the book.
And the book is called Everything I Want to Know About Real Estate.
It is.
Simon Giannini.
It is.
And you're updating this every year because things change every year.
The real estate market changes, the mortgage rates change, the areas that you want to invest change. So we're updating it every single year, but the basics are the same. The basic building block is really, really simple. Instead of waiting to buy real estate, you buy real estate and wait. We invest a little cash, we invest a little time, but because of the 3 or 4 ways that we're making money when we're investing in real estate, and we haven't even talked about other types of passive investments that you can make, and you talk about it on the show all the time, it really is the only asset class that makes sense in today's world.
The other things you're talking about, whether it's a REIT or a MIC or land development or investing in mortgages or stocks, all that kind of stuff. We can make money. The 3-4 ways, just to recap again, the 3 or 4 ways, I mean there's many ways, but the predominant 3 or 4 ways to make money in real estate, go over them again for the viewers.
Real estate always goes up in value.
Yeah.
So you're going to make money when the appreciation goes up over time.
Yeah.
As long as you ride out the storm of occasional blips in the marketplace. Number 1. Number 2, cash flow. We're always looking for properties that carry themselves or better.
Yeah.
In Mary's example, she took a property that barely carried itself and turned it into something that gave her positive cash flow.
Yeah.
At the same time, we're reducing debt. We're paying off our mortgage.
Somebody else is paying off my mortgage.
Somebody else is paying off my mortgage, and it's tax-free.
Okay, that's the third way. And the fourth way?
And the fourth way is when we see properties that are underperforming or need rehabilitation, they're not performing at their highest and best use. We can walk in, we can clean them up, we can increase the value, release that extra income, and that's another way we're making money.
And that's a huge way because, as investors, we shouldn't get emotional about this. In fact, I want the ugliest house on the block because with a little bit of lipstick, some Band-Aids, or full out open heart surgery, we can really increase the value of that property, and then therefore my return on my investment goes up.
Once you understand the mechanics of that forced appreciation, when you're looking at investment opportunities, you're looking for that delta, and I call it the bag of money.
Yeah, the bag of money.
I'm looking for the house with a bag of money that nobody else sees. And you know what? A lot of people pass over the ugly house because the grass out front is not that nice, or the kitchen isn't the color that they would like. When you look as an investor, you've got to put on a different pair of glasses. You got to look at what's my return, what's my security, what's my long-term opportunity, and where's that delta? Where's that bag of money I can find if I can see the opportunity, if I double check my numbers, and I do the work to liberate that bag of money.
Yeah, and it doesn't have to be, somebody like Mary who, is now going on to her 4th property, 5th property. I may be just content with just even one.
Start with one.
Just start with one property, you know, as a
all the more reason when you start with your first one, it's critical to make as much money as possible to get your real estate portfolio rolling.
Yeah.
And this is what we always look at. What do you have in resources now, whether you're a first-time buyer with limited resources, or this is your third or fourth or 10th or 20th property? What's the current status of your real estate portfolio, and what are the returns on investment you're getting on your money right now in every case if you have multiple investments?
Yeah.
And can I increase the return on investment? Can I do it safely? Can I do it without losing sleep at night? And can I do it intelligently for the long term? Okay,
so let me drill you with some questions here, and then we'll go to what we were talking about before of why, Simon, it's not always the best thing to pay off your entire mortgage. But the first thing, let me drill you with some questions because we want to go through these on the show. Typically today, GTA, we purchase a property, we tenant it out, we don't do much work. The return on investment should be?
Minimum 25%.
Minimum 25%.
Minimum 25. I won't even look at something that doesn't give me 25.
25%. Just with the three ways.
Just with the three ways.
Just with the by going up naturally, by somebody else paying down my mortgage, and by some cash flow.
And usually with very little cash flow, because that's the state of the market right now.
Okay. And when do I get to enjoy that 25%? And that's going to kind of lead into the next conversation.
Absolutely.
We'll hold that for a second. When do we get to enjoy that 25%? What is the minimum investment amount needed now in Ontario?
Well, it depends. I mean, look, I tell people invest what you have.
Yeah.
Beg, borrow, and plead to raise capital. And you can get creative. A lot of people are tapping into their home equity.
Yeah.
And that's another discussion altogether.
Yeah.
But you can get into a small investment with an entry-level condo in Toronto on the subway line for $250.
Yeah. And so what is out of pocket? Is it still 20%?
Well, still 20%. So you can buy with $50,000 plus closing costs.
Yeah.
And if you're short on cash, we have people that are pooling funds. And first-time buyers. We have two young brothers. They just got out of university. They don't have a lot of cash. They probably begged and borrowed a little. They raised their 50-60. We put them into a condo. There's very little maintenance. You're not going to get the highest returns in that, but you're getting into the market.
Yeah.
So you may not get 40 like Mary did with 2 units, but you will get 20, 25, 28%
all day long.
Get into the market, build that portfolio, expand as you go along. And the thing that people don't understand as well, that experienced investors do, is you don't need to come up with a down payment every single time. So you can actually build up equity in that property, refinance, pull some money out.
Let's touch on that. We're going to go to break in a minute.
Yeah.
Why is it not good to pay down your mortgage all the way? Because we want to be able to take out and buy another property.
Well, look, if you look at the equity in your home, we can sit down and show you how to calculate your current ROI. So an extreme example, let's say you own a $500,000 home and you have no mortgage, and the market appreciation is 6%. Well, you're getting a 6% return on investment in your home. You got to live there, so you can't account for rent because you got to pay rent somewhere else. So even if you have no mortgage, you've got property taxes, utilities, maintenance, and so on. We can show anybody how to take that 6% return on their investment and convert some of it to a 20, 25, 30% return without any risk.
Take out a little bit, put it into a property.
Borrow $100,000.
Yeah.
Buy a property like Mary's.
Yeah.
Get a 30, 40% return on that money there. And then pay it down. And you're also paying down that $100,000 in your home as well.
Use the cash flow
to
pay down where you order from.
Not everybody's sitting with an extra couple $100,000 in cash, but we know a lot of people that have equity in their homes.
Yeah.
And it's one of the sectors that's really growing because people are starting to understand, hey, you know what? I can borrow on my line of credit, usually 3.5%, 4%.
Yeah.
And then I can borrow at, let's say 4% to be conservative. I can borrow at 4% and make 30%. So how often do you want to borrow at 4%? Using the bank's money to make 30%? And the answer is, well, as often as much as possible, without getting into a risky threshold.
Yes. Listen, I love having you on the show. We're going to take a quick break.
Love being here.
We'll come back with some of your closing thoughts as we conclude. You're watching The Everyday Investor. It's been a phenomenal show thus far. We're not done yet. You don't want to go anywhere. The Everyday Investor continues in a moment. If you have any questions pertaining to this show or there's a topic that you would like covered, please visit Hey, it's Rav. Welcome back to The Everyday Investor. We've been talking to my good friend Simon Giannini, real estate investing expert and teacher. Simon, it's great having you on the show. Thank you so much for being here. I'm always nurtured. It was great having Mary on the show as well. There's a lot of people that watch this show. What would your, kind of closing thoughts be for them about, just real estate investing even in general? Yeah.
Well, you know what I see most often, and there's a lot of people out there, and you probably know who you are. You're stuck in paralysis by analysis. It's
paralysis of analysis.
Yeah, I meet people that want to learn everything first, to understand everything first before they take action.
Yeah.
And it's kind of like needing a black belt before you take your first class. You met Mary. Mary's a great woman, a great investor, but she's learning along the way, and that's part of the game. Yeah. And what I tell people is, decide to take action, and then just do something. And we're not looking for perfect. We're not looking for the ideal property with the white picket fence that's ready to go with the high cash. What you want to do is you want to pick a class of investing, pick a property type in an area, invest close to home, but make sure when you're investing that it makes sense, that there's cash flow, you can manage it, and just do something. And let the rest take care of itself. But the other thing I want to add is Google is not a research department. You can't do this on your own. You need to rely on experts. You need the finance people. You need a proper agent that understands that market. And with all due respect to my 40,000 licensed agents in the GTA, some are specialists in real estate investing, and those are the ones you want to reach out to.
Absolutely.
And
as well as when it comes to your accountant, your mortgage specialist,
everybody.
Your realtor, they have to know real estate investing.
They have to know real estate investing. We've seen lawyers that are great at real estate law closing deals, but they're not the advisors you need for tax. Yeah. And vice versa. So assemble your power team, we always say. Have your team of advisors, just like any other corporation would have their board of directors. You need to assemble your team of advisors that'll help you make the right decision and help you stay out of problems, stay out of trouble.
Yeah. No, listen, Simon, it's you're a wealth of knowledge. I appreciate you being here. You're on the radio, you're on TV, you've written books. People want to get a hold of you. They go to your site and they can get some more advice.
Best is to give us a call.
Yeah.
Number should be on the screen at some point. 416-443-0300 or info@reccanada.com. We've also got a website, realintel.com. Lots of great information there.
Thank you so much for being here.
Pleasure.
Look forward to having you back.
Yeah.
We're talking to my good friend Simon. We've learned how to make some money in real estate. On behalf of Rogers TV and myself, Rav Toor, we'll see you next week, same place, same time. Honey, I love you. I'll see you soon.